Hello everyone, in this video we will discuss about benefits of holding stocks for the long term. A long-term investments strategy entails holding investments for more than a full year. This strategy includes holding assets like bonds, stocks, exchange traded funds, ETFs, mutual funds and more. Individuals who take a long-term approach require discipline and patience. That's because investments must be able to take on a certain amount of risk while they wait for a higher reward down the road. Investing in the stock and holding them is one of the best ways to grow wealth over the long term. For example, the S&P 500 experienced annual losses in only 11 of the 47 years from 1975 to 2022, demonstrating that the stock market generates return much more often than it doesn't. Better long-term returns. The long-term asset class refers to a specific category of investment. They share the same characteristics and qualities such as fixed income, assets, bonds, or equities, which are commonly called stocks. The asset called class that's best for you depends on several factors, including your age, risk profile, and tolerance, investment goals, and the amount of capital you have. But which asset classes are best for long-term investors? If you look at several decades of asset class, we find that stocks have generally outperformed almost all other asset classes. Emerging markets have some of the highest return potentials in the equity markets, but also carry the highest degree of risk. This class historically earned high average annual returns, but short-term fluctuations have impacted their performance. For instance, the 10-year annualized return of the MSCI Emerging Market Index was 2.89% as of April 2022. Ride out highs and lows. Stocks Stocks are considered to be long-term investments. This is in part because it's not unusual for stocks to drop 10% to 20% or more in value over a shorter period of time. Investors have the opportunity to ride out some of these highs and lows over a period of many years and even decades to generate a better long-term return. Looking back at stock market returns since the 1922s, individuals have rarely lost money investing in the S&P 500 for a 20 years time period. Investments are poor market timers. Let's face it, we are not as calm and rational as we claim to be. In fact, one of the inherent flaws in investments behavior in the tendency individuals claim to be long-term investors until the stock market begins falling, which is when they tend to withdraw their money to avoid additional losses. Many investors fail to remain invested in stocks when a rebound occurs. In fact, they tend to jump back in only when most of the gains have already been achieved. This type of buy high, sell low behavior tends to cripple investors' returns. According to Dalbar quantitative analysis of investors' behavior study, the S&P had an average annual return of just over 6% and during the 20 years period ending December 31, 2019. During the same time frame, the average investor experienced an average annual return of about 2.5%. For more videos, subscribe our channel. Keep watching and subscribe our channel. Click on bell icon for more updates. Keep watching and don't forget to subscribe our channel. Take care. Goodbye.